We are approaching summer, and the housing market has not crashed so far. The evidence is there that we are at the edge of the worst housing crash in recent American history. However, there are no significant changes in the price stats. This minuscule decline is nothing compared to what we witnessed 3 years ago. The pandemic hit the world really hard, including real estate. From March 2020 to June 2022, the price of a medium home increased by 45% as measured by the Case-Shiller Index, which was not thought to happen. Investors were over the moon as they earned handsome capital gains during this era of supergrowth. Owners rejoiced in record equity, while buyers were desperate as prices got worse month after month. In June of 2022, after a parabolic growth for 27 months, the market finally took a breather. In the last summer, the Case-Shiller Index was at its top, i.e. 45%. But from that point on, things began to change. The prices fell from peak to 3.6% in 5 months. It seems to be nothing compared to what has happened during prior years. However, it does show that another housing crash exactly like 2008 is approaching. The latest data provides the evidence, which is updated on a weekly basis. For instance, the latest Case-Shiller Index shows that house prices have declined for 5 straight months. The history of the real estate market shows that this kind of decline is rarely seen. Since 1986, the Case-Shiller market has never dropped more than 3%. The only exceptions are 2008, and another small drop of 3.05% in 1990. Though this tiny drop appears to be nothing on the graph yet, it is extremely significant, and it's demonstrating that something huge has been changing in the real estate market. Experts speculate the real estate market is in the denial phase of the crash. It is largely assumed that private sellers are the price sellers, yet earlier crashes showed that they're not. Rather, they are always the last ones to move the price. In the majority, or most of the markets, builders, i.e. multi-billion-dollar corporations, do this with the help of well-structured teams to set the prices. Nobody understands supply and demand better than they do, and they enjoy higher incentives in moving the prices down in order to move the inventory. Every serious builder has moved their prices down in the last quarter. They did it with the help of incentives, such as buy-downs to push people to buy. The Case-Shiller Index seems to be doing fine, but it does not depict the true picture of what's happening. The recent earning reports of the major builders have revealed serious issues in the market, which will take some time to witness the effects of these actions on the true existing housing market. It cannot be denied that these developments will affect the new home space. Just assume that you decided to buy an existing home. A new home has suddenly reduced its price by 20%. Your decision to buy the existing one will be changed. So in short, the new homes anchor the prices. However, it will not wipe out the post-2020 gains in a matter of days. We are all well aware that real estate crashes take a long time to occur. Let's have a quick look at the last crash to have an idea about the pace of real estate market crashes. In July of 2006, the prices reached their peak, and then they began showing a downward trend-like snail movement. In July of 2007, the Case-Shiller was down only 1.95%. So considering the same, we can see that in these 5 months, we have declined more than is compared to the decline that occurred in 1 year last time. In July of 2008, the prices were down 10% only. Following the Case-Shiller Index after a fall of 27.4%, it would have taken 5 years and 7 months to collapse and reach the bottom in February of 2012. Afterward, following this collapse, it would take an additional 5 years to return to the price peaks like in 2006. Overall, the cycle ran for 10 years and 6 months. So in short, home prices don't just drop overnight. It is a slow and gradual process beginning with the builders and then flowing down throughout the market. The process is not at all linear. Possessing a home is the dream of every American, and it's under a real threat at the moment. Take a look at this graph, compiled with the help of the data from the U.S. Census Bureau, the U.S. Department of Housing, and the Fed. We made it by taking the median home sales price for every year beginning from 1997. We plotted the payment required to cover, assuming that we put down 10%, and then pay the national average for insurance, PMI, and taxes. The average interest rate was integrated for each year, and then this number was divided by the median income of a household. This gave us an affordability chart. Hence, this chart plots the percentage of monthly income that an average American has to pay if he had bought an average house in that particular year. The affordability can be seen to hover at mostly 39% of the last 25 years. In 2008, we saw that affordability reaching 46%, where the entire banking system buyers forced the prices and interest rates to collapse. It led to improved affordability, which hovered around 35% for several years following 2008, before it slowly crept back to average. In 2020, we saw the unimaginable happening. The measurement moved up and it kept going. The median American who purchased a house in 2022 now pays a mortgage of 52% of his gross income before tax. We are above the relative prices now compared to 2008. So if 2008 was the worst real estate bubble, well, we need to see the difference between that and this crash. The simple conclusion is that provided the current interest rates, prices, and income levels, this may not continue anymore. One of these mentioned factors has to give up. Tracing back history, the income levels may not be able to catch up with the other variables. If we believe in Jerome Powell's words, then we are clear that interest rates will remain up. Powell said that, and I'm quoting, Fed will continue to raise the rates throughout this year. This leaves only one variable left, which is price. Looking at the chart, we can conclude why the whole scenario is calling for a crash. It is unaffordability. Although unemployment is at a record low, while income has done very well over the past 5 years. In short, without demand from normal Americans, it will be difficult for supply to be at the lower end. As soon as the situation of inventory begins to unfold, well, we'll see the prices as well. Usually the whole process takes years. However, if we come across turns like we did last summer, it is a strong indicator that we are about to enter a long bearish market in the coming year, beginning with the builders. Looking at the earnings reports of the nation's largest builders in our earlier videos, the evidence, it's very obvious. Builders have slowed down, they have reduced the prices, and they have increased the incentives. The action we saw last summer will begin to flow into the rest of the market. Very similar to the summer of 2006, and the next 3 years, they may head in the same direction as well.
We've both had a fair amount of experience in real estate, and Charlie made his early money in real estate. The second point is the more important point. Real estate is not a commodity, but I think it tends to be more accurately priced, particularly developed real estate, more accurately priced most of the time. Now, during the RTC period, when you had huge amounts of transactions and you had an owner that didn't want to be an owner in a very big way, and they didn't know what the hell they owned and all of that sort of thing. I mean, you had a lot of mispricing then, and I know a few people in this room that made a lot of money off of that. But under most conditions, it's hard to find real estate that's really mispriced. I mean, when I look at the transactions that REITs engage in currently, and you get a lot of information on that sort of thing, you know, they're very similar, but it's a competitive world, and you know, they all know about what a Class A office building in Chicago or wherever it may be is going to produce. So at least they may all be wrong, as it turns out, because of some unusual events, but it's hard to argue with the current conventional wisdom most of the time in the real estate world. But occasionally there have been some, there could be big opportunities in the field, but if they exist, it will certainly be because there'll be a lot of chaos in real estate financing for one reason or another. We've done some real estate financing, and you have to have the money shut off to quite a degree, probably, to get any big mispricing across the board.